Gold has really been a great performer. It's outperformed a lot of things, but people don't look at it that way because they see the period where it broke down and like, hey, it's not working. But over time, you have to keep gold.
Please join us for our next live stream Sunday, July 11th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, July 11th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you're new to our channel or if you haven't already done so, please do subscribe, hit the bell to be notified of new updates, and give us a thumbs up if you like what we do. We truly do appreciate your support. Ted Oakley, founder of Oxbow Advisors and co-founder of his predecessor firm, HPO Advisors, joins us today on SBTV as a first-time guest. Ted has over 35 years of experience in the investment industry. The Oxbow principles and the firm's proprietary investment strategies were developed as a result of the unique perspective Ted gained throughout his almost 4-decade tenure as advising high-net-worth investors. And we're delighted to have Ted join us here today. It's time to saddle up and silver up for Ted Oakley. Ted, welcome to SBTV. How are you doing?
I'm doing great, Patrick. Thanks.
Glad to have you here, Ted. Ted, since you're our first-time guest here, can we have you start by telling us about yourself and what are the Oxbow principles?
Well, what happens is, our company has really been a company that's worked with business owners after selling their companies for like 35 years. So we work all over the country, all over the world. And we just had a niche in that area a long way back. And so we understand that particular part of the business really well. And that's a different, it's a difference between, in one respect, inherited money and how you make money as an entrepreneur. And that's really the market that we went after over time. And one of the things that we really put into the Oxbow principles was this, and that is when you have a lot of money, you need to break that money down into a couple of categories so that you don't just put it all together. And one of the things we say is, you have safety capital and you have investment capital. They're two different things. And I find that people don't keep that in mind. Why do we have safety capital, and why do we say that is because we think everyone, no matter how much money you could have $1 million or you could have 100 million, but everybody has a choking point where when their assets get to a certain level, they really can't think clearly. And so we've always felt like you've got investment capital and you've got safe capital. And if you confuse the two and everything's in one pot and everything's investment capital, when you get into harder times, people don't have anything to throw, to lay back on. And the problem with that is then you get into where you make poor decisions. As long as you have a safety valve, hey, I'm going to survive. Survival is the key. I'm going to survive, then you're okay. And in the Oxbow principles, that's really the basis of where we start. And then we just take it from there.
Yeah, that sounds pretty interesting because I hear people all the time say, Patrick, there's a time to make money and then there's a time to protect what you've made. So I guess this kind of falls into that Oxbow principle.
It does. I think people confuse the two, particularly when things have been good for a long time. I find more and more people now. I mean, I'll be talking to somebody at a dinner party, 80-year-old person, maybe sometimes. I was at a meeting the other day, 80 years old, and they're 80, 85% in stocks. That doesn't work when times will get bad again. And so what happens is, they're not thinking clearly. And that's really a result of what's been going on the last 10 or 11 years. And so they get caught up in what I call recency bias. And I have a new book coming. We've written a lot of books, but one of the books we have coming out in about a month is called Your Money Mentality. And one of the things we ask people is, do you really know what your money mentality is, where you are on the spectrum of risk and reward? A lot of people don't, but they get caught up in what's going on at the time, good and bad, by the way. The same thing when times are poor, and you need to be looking at the advantages of maybe buying things cheap they're frozen. And so it's at both ends, really.
Oh, true. That is. Look forward to seeing the book come out. Looking back at your quarterly May call 2021, your first topic was inflation. Has anything 2 months since affirmed that inflation is indeed a growing concern, and is it transitory?
Well, one of the things we write a lot about that too, but one of the things I find is that everybody's been caught up on the word transitory, and transitory could mean a few months or a few years for that matter. And I will tell you this much, Patrick, I am one of the few people that have been around when we did have inflation. So I know what that's like in dealing with things, but here's where we are on it. I think it's too early for even the Fed to say that it's transitory, because if you look at what's happening in the supply chains, in the pricing of things, and everything along that line, their whole premise is it's based on base effects. And well, we came out of this COVID economy, and then they don't have the ability to do it. I don't know about that. I think you won't know that until you get into the third or fourth quarter, but I suspect that we'll stay up above 3% through the third and fourth quarter. And then the Fed will have to make a decision on, what will we do here?
And that's also interesting again, because our followers, they know that I've long said that if the Fed couldn't get the inflation that they wanted for over a decade or about a decade, what makes anyone think that they can control it when it finally does come? Ted, what are the most probable ways do you think the Fed will try to control this inflation if it goes beyond transitory?
Well, what I think they would do is, they'll get in a situation where I think first of all, they'll jawbone it. They'll try to talk it down, which they're really good at. Now you're talking about probably the number one world's cynical person, me, when it comes to the Fed. I've told a lot of people this, but the last Fed president, I believe, was Paul Volcker. Since that time, nothing has ever come true that they wanted to say. But here, the thing about it is, I think what they'll try to do is jawbone it. The second thing they'll try to do is they'll try to do their gradual approach. But the problem of that is once you get past maybe 4% or 4.5% on inflation, you'll have to make a move of some kind. And they're caught in a really tough situation, Patrick, because what happens is, think about it. If they decide that it's getting away from them, they would have to go in and raise rates. If they don't do anything, and the market itself moves inflation up, and they're behind the curve, then they're really in a tough situation. Either one of those, by the way, are probably bad for the stock market. And their number one concern, unfortunately, they're not an independent anymore, is the stock market. So, if the market breaks, 15, 20%, they would come in immediately and start throwing cash around. But it gets to a point where that cash doesn't work anymore, when they're only getting, 30 cents off of each dollar of debt that they throw in. So I think they'll be caught in a squeeze, and one of those will end up being a poor economy if they're not careful.
Many CEOs from various companies, from industries from Coke to Chipotle and beyond, have raised concerns about inflation from the raw materials and commodities levels, and have said in turn that they are going to have to raise prices. On the other hand, some companies, they haven't raised prices, but instead they've shrunken their product, something known as shrinkflation. Ted, what are you seeing as far as shrinkflation, and is this something you think consumers are even aware of?
Only to a degree, Patrick. One of the things I find is people look at price, and so one of the things we included, we do a quarterly call, and the last quarterly call we did last quarter, we included about 30 of those, but we have about 250 that we had really noticed, but I think there are hundreds of those, and that's actually not something new. That actually happened also in the late 70s. The very same way we saw things shrink down, and I people won't remember this, but when I was in the commodity side of the business, in the food business, really, we were taking margarine, for example, and you probably wouldn't remember this, but they would have, at the time, they would have bars of margarine. And so what they started doing was whipping it, the whipping it in the bowl, but they would use 20% less margarine because prices of soybean oil and everything were rising. Well, we're doing the same thing now.
Yeah, Ted, I do remember. I mean, my mom, she would always buy that cereal, Life cereal, hey, Mikey, he likes it, that cereal. And I remember opening up that package and it's like half full at best. You see the cereal become less and less in that cereal box. So yes, I do remember.
I brought it up to my staff about 2 years ago because about 2 or 3 times a year I have a Butterfinger. And I said, I've noticed this the last 5 years. I'm getting down to where Butterfingers are like nuggets now. They're not a bar anymore. And so we really started that a long time ago, starting to look at that. And, but it's true thing. And unfortunately, it hurts the lower income people a lot. And I feel for them.
Yeah, it's true. I remember my family really felt it back then as well. One metric, though, that the Fed likes to use to gauge inflation is the velocity of money. My question here is the velocity of money becoming less and less of an important way to gauge inflation, being that if the money supply grows so much quicker and far outpaces the ability to spend, this will naturally widen that gap, and the velocity of money will naturally stay on the low side, having the Fed think, no, velocity of money is low, so there's no inflation. Do you think the velocity of money is starting to become perhaps less relevant because of the amount of money that the Fed has printed?
Well, Patrick, where I think they miss it is sort of the old timers use velocity of money relative to bank loan, how you turn money through the banks and you multiply it over time. What's really happened has changed that market the last 8 to 10 years is that you have a lot of money being loaned that does not go through the banking system. It's a shadow system. And so the mezzanine, everything, private equity, there's so many things that are being loaned that affects the banks. If you look at their C&I loans and everything, they've been declining now for like 3 years or 4 years. It throws that off a bit. And I don't know if the Fed has a great way of determining that because they don't, you can determine what goes on at banks because you've got the OCC and the federal, and they can see what happens in the state banking systems, but you can't see it on the other side. And I think that's thrown it off a bit. It's probably more than people think because the formal velocity numbers keep falling. I understand that, but I think there's slippage in there that people can't see.
That's a great point. Ted, with high prices on our minds as we've been discussing, but in a time where unemployment is high, businesses being on a ventilator of sorts, and many now buried 6 feet under, how are we continuing to see the equities markets continuing to rise?
The primary reason you're seeing it is because when you ended up with a lot of money and a lot of supportive assets, one of the things that you ended up with is, was the TINA thing. There is no alternative. And what happens is, and I find this true at all extremes in asset pricing, and that is when something's been really great for a while, you see that coming up, but then you get to a point where at the end everything becomes really speculative, and that is everybody throws caution to the wind, and we see it now in everything. By the way, we see it. We don't see it in commodities, but we see it in real estate. We see it people buying private businesses. We've never seen that like we see today, and we see it in the stock market. And so what's happened is the idea. Give you a statistic. Average bear market's about 14 months long. It's going back over time, last 50 years. We had roughly 58 days during December of 18, and last year we had 28, which was during March. And so people get this idea that, they're not going to let the market fall. And so you have a lot of novice players that don't really understand what happens in bad times. And so they just keep putting money in. And I've just noticed this year, for example, we've had a record number come into on the equity side. And at some point in time that turns and you go the other way. And you have to think about it like this. If everybody, if roughly, 65% of the money is going into, say, exchange traded funds or indexes, think about what happens when you turn that the other way. And all of a sudden people want to hit the button because I want to get more liquid. And they don't realize that when they're selling, they're not only selling the big names that have a lot of volume, but they're selling the mid-size and the small names, which don't have much volume at all. So all of a sudden you get this extreme the other way, and nobody's thinking about that, but that's what comes out of all of that. And the markets are up here now where you can't sober people up. I've been here before, by the way. And so it's not surprising to me, but it's all supported by the Fed. I mean, the Fed has created the entire marketplace is being created by the Fed. And I blame them for what's going on here.
Yeah, I was going to ask you a question about that, where are you expecting a correction in the equities markets? And I ask this because, I see analysts, just as you mentioned, along these lines of where they say, don't fight the Fed. The Fed is propping up the markets and you can't lose. And I hear them using words like recovery to a point where it seems no one fears or is even adjusting their, let's say, portfolios for a correction. But are you expecting a correction in the equities markets?
Well, we do at some point. The problem about corrections is the timing of it. And for us, for example, I'll just give an example. We've been carrying higher cash levels for 3 years. Now, we did use some of it last March on a short-term basis, but we're basically where we've always been. And the reason for that is because when prices are really extended in all of these companies, you can jump. If you want to be in it and say, I just want to be in the marketplace, that's one thing. But if you want to buy things based on a true business acumen, I'm looking at a business deal here, then you can't be 100% invested right now. And I'll argue that point with people all day. And they have this, the idea they come back with always the same is that, well, if you miss this part of the market, et cetera. The problem with that, though, Patrick, is when people lose 40 or 50%, that perspective goes out the window. If you come back to them and say, hey, by the way, we're in it for the long term, they will laugh at you. Because I tell all the portfolio managers over the year, I said, everybody is always long-term oriented until they lose money. and then they're short-term oriented. So no, it's we expect that, at some point in time. I think it probably would come. Normally, it comes between the first and second year of an administration. So I could see with all the spending that's going on and that sort of thing. I think that will have an impact. Well, by the time you get into 22, for example, a lot of this stuff is going to start to show up. And I think that's where people are going to have to say, hey, I don't think I want to be around this long. So we'll see if that happens. But I mean, for us, we still have a lot of cash. So we're in that position.
Okay. How much of a percentage-wise do you see the market correcting?
Well, what happens on these highs like this, and they're all sort of the same. You could go back over history. You'll usually get a break. You'll get a break of 15, 20%. And I could see the Fed rushing in and making sure everybody feels good again. And then you'll typically have those prices move back up toward where they were. They won't, and sometimes they'll go to a new high, but you'll see, but the demand slows down, but the prices move higher. It's the second drop, the second one that you hurt everybody. And I could take you back through a lot of different highs in the market, but that's the one that really gets you. And my idea would be we'd probably get something quick in the beginning, and people would think, hey, it's over right before it really gets going.
Small business, the backbone of America. Having said that, valuations are incredibly high right now, and you have suggested that depending on your circumstance, this might be a time as a small business owner to consider selling.
Patrick, I've been talking to business owners and doing merger acquisition and referrals of people to cross sales since 1984. And I've seen one of the things that happens is the businesses change over time, and the types of businesses that are being rolled up over time change, but the business owner mentality never changes. It doesn't make any difference where you're doing tech today or you were doing waste management back in the 80s. What happens though now is that the prices have gotten so ridiculous that, in my opinion, if I were a business owner and I were thinking about selling the next 3 to 5 years, in my opinion, you will never get, ever in your lifetime, another chance at the prices like they are today. And I know some people will say, well, I'm not ready to sell. I understand that. And I bought and sold businesses myself. But the point being is that when you get prices this extreme, you need to go ahead and move your calendar up and say, hey, you know what? I'll take advantage of this. And if things change to the negative side, I'll have a lot of capital. I'll go out and do something else.
Okay. And you kind of touched on this as well with the administration, and what's on their mind right now is infrastructure and things like that. But can the U.S. tool up and fire up the mills and factories and farms to compete in the world in manufacturing and production, and attract foreign direct investment the way it once did before, with the promise of growth and ingenuity? Or have these days passed?
I think they're past. Well, I'll tell you why. I think that everything they're doing now, eventually, okay, now if you look at the last 18 months, the dollar's gone, from, it's down, got all the way to 90, back up to around 92. We think long term, though, the dollar continues to decline. You can't have a declining dollar and go back to what you were describing, Patrick. Those two don't go hand in hand. Basically, if anything, that would mean we would get into stagflation. So I don't think that happens. I think you get into a situation where people will talk about that and they want to, bring out and really pat themselves on the back and that sort of thing, but it won't really happen because the dollar will be declining.
Yeah, that's a tough one to hear. Ted, the money printing, stimulus, weaponizing the dollar, central bank digital currencies, all these signs are signs that the world is wanting to move away from the US dollar, or perhaps into a new monetary system. Does the USD, and we just mentioned it going lower, does the US dollar have a sort of an expiration date on it, with the world awash in US denominated debt? What will that mean when the clock does strike 12 and the dollar expires?
Well, Patrick, I think what happens now, everybody thinks now that the dollar is invincible. But if you look over history, for example, look back in the 1800s when England was the reserve currency. I mean, you can go back through many years of history, and you'll see reserve currencies. They all moved on to another currency eventually. What we have right now are people that think that we're invincible on that side of things, which I think what they're not seeing is that when you have a decline in what's going on in your economies, you have a decline in capitalism, you have a decline, that sort of thing. Over time, it will be a slow erosion. Now, right now, they're still in the driver's seat at 60% of reserve currencies, but what's happening. I mean, China's coming after them, and I see them. I see them being a major factor toward that over the next 10 years.
Okay. And, in a time where currencies, they are becoming a bit problematic, too much money printing, debasement, as we've been talking about, or even national policies that are just unattractive. The history does point to gold to account for fiat failures. Are we looking at history repeating itself where gold will have to account for paper currencies?
I think so. We own gold, we own some miners, we own silver, but we own more gold. And the reason why, I mean, a lot of people are like, well, you should own the coins, And one of the things you find about, we're not going to walk in here in a 2-week period, I don't think, and have gold down 50%, like a Bitcoin or something. One of the things about gold is, and yeah, it can correct a bit and that sort of thing, but if you look at what happens over time, and you go back and you look at commodities as a group, really relative to financial assets, and I've got a graph going back to 1925. They're at an all-time relative low relative to financial assets. And so if you look at all of that combining, gold should be right up at the front. And one of the things about gold is over time it's come in and out. And I don't think most people know this, but if you go back to January of 2000, gold has really been a great performer. It's outperformed a lot of things. But people don't look at it that way because they see the period, like, for example, from 2011, where it broke down and like, hey, it's not working. But over time, you have to keep gold. That's the thing. And so, yes, I think it will. And I think it probably over time would surprise people at how high gold might go.
Okay, Ted Oakley, any final thoughts that you would like to share with our viewers?
The final thought I would have, and I mentioned this to people really, is that try your best not to get caught up in all of this speculative fever. And right now we have 4 or 5 aspects of speculative fever. We have the stock market, we have real estate. I have people leaving their businesses to go flip homes, for example. Real estate, we're seeing that. I'm seeing it in NFTs, non-fungible tokens, incredible joke in our opinion. SPACs. If you look at the entire spectrum of speculative activity, cryptocurrencies, it's really off the chart. And it makes me think that when you have that speculative activity pulled out eventually, that you'll have a lot of people lose a lot of money. So I think if I had to tell people something, it's try to keep your head on straight in here. It's time to do that.
Okay, Ted Oakley, before we wrap up, could you let our listeners know how they can find more of your work and about Oxbow Advisors?
Well, at Oxbow, if you come to oxbowadvisors.com, you'll see everything you want to see there. We have 9 or 10 great books about situations when people have come into a lot of money. And you'll see a tremendous amount. We do a tremendous amount of writing. We do a tremendous amount of videos ourselves, just describing where we think we are in the marketplace. If you come to oxbowadvisors.com, you can see all of that. And certainly if you had a question, there's a number on there. You can call someone. We'd be happy to give you any information you might not see.
All right, Ted Oakley, we appreciate the time you've given, and I hope we can do this again soon.
All right, Patrick. Thank you.
That was Ted Oakley sharing with us his views on the markets and the economy. For more of his insights, please visit oxbowadvisors.com. If you like this video, please give it a thumbs up and subscribe to the SBTV channel. Audio versions can be found on SBTV iTunes or SBTV Spotify.